2021 was a record-breaking year for Wall Street and Silicon Valley. We witnessed a staggering surge in global venture capital funding, soaring to a remarkable $643 billion, a 92% increase compared to the previous year. At the same time, the S&P 500 index climbed nearly 27%, reaching record highs. The dynamic financial landscape of 2021 provided a fertile ground for numerous high-growth startups to seize the opportunity and make their debut in the public market. This is why there were 1,035 IPOs in the US in 2021, completely shattering the previous record. The financial environment benefited one particular set of companies, those implementing a direct-to-consumer business model. Figs, a healthcare apparel brand, IPO'd in March 2021, valued at over $4.5 billion. Warby Parker, a direct-to-consumer eyewear startup, made its public debut in September 2021 at a $6 billion valuation. Allbirds, a direct-to-consumer sustainable shoemaker, went public in November 2021 and was valued at $4.1 billion. Fast forward to 2024 and many of these companies are struggling. Warby Parker's stock is down by 75%, Figs is down by 85%, Allbirds trades for less than $1. Other direct-to-consumer darlings like Casper and Blue Apron were sold and taken private after struggling to perform. Let's analyze the direct-to-consumer business model and understand what led to this situation. The direct-to-consumer business model is a strategy where manufacturers or producers sell their products directly to consumers, bypassing traditional intermediaries such as wholesalers, distributors, and retailers. While brands that sell directly to their consumers through brick-and-mortar stores can be classified as DTC, the current definition of this business model is almost synonymous with e-commerce. Say you come up with a new healthy dog snack. Traditionally, your main goal would be to try to get your snack in as many stores as possible, but following this business model means that your brand has to compete for shelf space with a number of more established legacy brands that already have a loyal customer base. You decide to go another route. You start by creating a modern website selling only your own brand. You use digital marketing tactics like social media ads and sponsorships to drive people to your website and generate sales. After a while, the brand grows, and now you branch out by introducing new items and maybe even opening your own stores. Throughout this process, you make sure that you sell directly to your customers. The DTC model has become popular because it has a number of benefits, at least in theory. The model allows the company to control the brand experience. By managing the entire customer journey from discovery to purchase and delivery, companies can ensure a consistent brand experience. This control helps in building a strong brand identity and customer loyalty. Additionally, selling directly to consumers allows companies to collect valuable data about customer preferences, behaviors, and feedback. This information can be used to tailor marketing strategies, develop new products, and improve customer service. However, perhaps the biggest advantage of this model is the increased profit margins. Theoretically, eliminating intermediaries leads to more savings, and companies can either pass these savings on to the consumer through lower prices or reinvest them into the business. But for many DTC companies, these advantages never materialized. What happened? Silicon Valley and Wall Street have always had an appetite for tech companies. These companies often have a much higher ceiling when it comes to growth and revenue. Think of a software company. Software companies can often reach a global audience, have great gross profit margins, and have the stickiest revenue because they have a recurring customer base. It has become common for a tech company to trade at a premium to other companies because investors anticipate more growth from tech businesses than from companies involved in more traditional industries. A DTC company that uses digital channels as its main method of selling its products is certainly tech-enabled, but not a tech company. DTC companies sell physical goods, which means that their margins are quite different from tech companies. This has not stopped investors from valuing DTC startups like tech companies. At its IPO, Allbirds was worth nearly 15 times more than its revenue. This is a multiple that's more associated with tech companies than shoemakers. To illustrate, Nike trades at a price-to-sales ratio of around 2.8. In the search for a high valuation, many of these DTC retailers position themselves as tech companies. And they did manage to get the high valuations they wanted, but this left them in a tough position. See, for a startup to justify its valuation, it must become profitable, or at the very least, demonstrate a viable plan to achieve profitability within a reasonable time frame. In 2022, interest rates started to rise. This made borrowing money much more expensive for investors. This, in turn, put additional pressure on DTC companies to present a path to profitability. And many of these companies failed to do so. Let's take a look at some factors that made it difficult for these companies to maintain their valuations and market dominance. To put it simply, not all products are well suited for a direct-to-consumer business model. Take Casper, a company that once reached a $1 billion valuation by selling mattresses directly through its website. In 2020, Casper sold approximately 511,000 mattresses through its DTC channel, generating $363 million in revenue. This results in an average order value of $710 per mattress. With the cost of production at about $350 per mattress, the company achieved a gross profit of $360 per mattress sold, translating to a healthy gross margin of nearly 51%. However, to generate this revenue, the company spent $146 million on advertising to draw traffic to its website. This equates to an average customer acquisition cost of around $285. While spending approximately 80% of the gross profit on acquiring a customer might be justifiable for businesses with high customer retention and repeat purchases, it poses a challenge for Casper. Consider the contrast with a software company that charges $200 per year for its platform, where many customers renew their subscriptions annually. After the initial acquisition, this company enjoys recurring revenue without significant additional advertising costs. Hence, it's feasible for such a company to invest heavily in customer acquisition because it can recoup the costs later. Casper's situation is different. Data indicates that the average American keeps the same mattress for 8 to 10 years, which extends Casper's repeat purchase cycle. Over this period, advancements in mattress technology and new market entrants also mean that Casper likely needs to spend on advertising again to reacquire past customers. Given these factors, the $285 customer acquisition cost is hard to justify for Casper because the long wait for repeat purchases necessitates substantial reinvestment in customer reacquisition. Since DTC is a rather lean business model, the barriers to entry are usually much lower than in other industries, and these low barriers make it easy for new companies to enter once the market has been validated by the first mover. The introduction of new entrants, especially in homogeneous markets, forces companies to decrease prices to attract and keep customers. Decreasing prices in an already fragile market can be deadly for many companies. This is exactly what happened in the meal kit delivery industry. In 2013, there were only 13 meal kit delivery services. At this time, brands like Blue Apron and HelloFresh were seeing a growing user base, which attracted the attention of VCs. However, once these companies made a name for themselves, this market attracted new competitors. In 2023, there were 323 meal kit services in the United States, a more than 3,000% increase over 2013. Some of these companies have turned to promotional discounts to attract new users to gain an edge over competitors. The idea is to bring new customers through low prices and then hope a large number of them stay and pay the full price after their first purchase. However, this has not turned out to be the case. In fact, meal delivery companies lose 90% of their customers within a year. This is because customers are constantly looking for cheap deals to take advantage of. This situation is a big reason why all meal kit delivery companies are currently struggling. Perhaps the biggest reason why the DTC business model is struggling has to do with ads. As was mentioned previously, these companies rely on digital marketing to create brand awareness and attract customers. In the early 2010s, when DTC companies were getting started, digital advertising was quite cheap. A company could spend a small amount to be seen by thousands of people. This obviously meant that the customer acquisition costs were low and manageable, and the entire DTC business model was built with the assumption that digital marketing is a cheap and highly effective way to acquire customers. But as time went on, more DTC companies popped up, and they all relied on digital marketing to drive customer acquisition. More importantly, even traditional players saw the importance of digital marketing for their products and started investing money in it. This led to a skyrocketing demand for digital marketing. By 2018, digital ad spending in the US surpassed $100 billion for the first time ever. By 2023, this number had increased to $201 billion. As the laws of economics tell us, an increase in demand usually leads to an increase in price, and this is exactly what happened. By the end of 2021, social media advertising costs skyrocketed. Facebook's cost per 1,000 impressions increased by 89%. The cost of advertising on Google and YouTube climbed by 108%. This led to a rising customer acquisition cost. Between 2017 and 2022, the cost to acquire a new customer climbed by 60%. This means that a lot of the models of DTC, which heavily relied on cheap advertising for customer acquisition, started to collapse. While trying to disrupt the entire system and eliminate the middlemen, some DTC brands have discovered that there may be a reason these middlemen exist. This is why many DTC brands like Peloton and Glossier have now incorporated wholesale elements into their business. But some brands are still insisting that their DTC model is superior and are trying to weather the storm. How they come out of this storm remains to be seen.